Capital gains tax for real estate, very relevant topic for anyone who is selling a home or investment property. I'm Craig Power with Power Realty Advisors, licensed in Massachusetts, so we will be talking specifically about cap gains in Mass, but wherever you are, it's all applicable. So, to all of our subscribers in like Indiana, go Colts, just kidding, Colts suck, go Pats. It's probably a good time to mention this is not legal advice, right? I'm not a lawyer. This is not tax advice. I'm not a CPA. But here's the long and short of it. When you sell real estate, it's subject to capital gains tax. There's actually federal and state cap gains tax. To simplify, a capital gain in real estate is the difference between what you bought a place for and what you sold it for. That's the easiest definition. So if you buy a house for $500,000 and you sell it for $600,000, you have $100,000 representing your capital gains, pretty much. That $100,000 is subject to the tax. At least that's where we're starting. We'll get further into details on exemptions shortly because depending on the situation, it's actually probably not subject to the tax. First thing you might be wondering, what is the tax rate though? At this very moment, it's different for short-term capital gains and long-term capital gains. In the short term, it's taxed as regular income. So let's say you do a quick flip project. The only flip I ever did, we actually only owned the place for a little over 3 months. So we had to pay a pretty high rate of taxes on the returns. If you're already a high earner, you could be looking at like 37% tax on something like that. Long-term federal rate is lower than the short-term rate. There's different income brackets for it, but really it's 20%. And you may have seen that the president may be proposing nearly doubling this up to 39.6%. I think he actually proposed making these basically both the same, short-term and long-term, making them both 39.6%. He was actually raising the taxes on regular income as well. I am a skeptic, to put it nicely, when it comes to any dramatic change like that in Washington, but we will see how it shakes out. The news cycle moves pretty fast these days, so I'm not going to stick on this for too long. The goalposts could be moved by the time I post this video. The difference between short-term and long-term is less than a year versus over a year of ownership. But let's get into the good stuff here though, which is exemptions, meaning how do you avoid paying these taxes? I have two different case studies here, one being your primary residence and the other being an investment property. In the case of the primary residence, I have good news for you. If you've lived in your home for more than 2 years, you'll be able to claim an exemption. You may not need to pay capital gains tax when you sell the home. For it to be considered your primary residence, you need to have lived in it for at least 2 of the last 5 years. Doesn't need to be consecutive. For an individual, you're exempt from paying taxes on up to $250,000 of gains. If you're married, it's up to $500,000. So for a married couple, you buy a house for $500,000, you sell it for $1 million, you don't have to pay taxes on any of that gain. The only condition is that it qualifies as your primary residence, meaning again, you've lived in it 2 out of the last 5 years, and also that you haven't claimed a recent exemption like on another property you sold within the last 2 years. Investment properties, obviously, you cannot claim this exemption. An investment property is not eligible, which brings us to the question, what other strategies can you use to lower your tax liability? Well, you can show expenses to reduce your taxable gain. You're allowed to deduct from the sales price your selling expenses. You almost treat it like write-offs. Think about selling expenses, real estate commission, attorney fees, recording fees. Take all that away from the taxable amount. Then you can deduct home improvements too, as long as they materially affected the value of the home. Okay, so there's a line here. So new roof or windows, adding a new bedroom or bathroom, installing a new fence or patio. You're supposed to have receipts to document this. Again, not a financial advisor here, certainly not a tax professional. And you can't deduct everything you do to the house. The key is all those things show up on paper. Extra bedrooms and bathrooms and stuff, those improve your home's value without anyone even seeing what they look like. You can't deduct like repainting and cleaning, your typical spring cleanup. In the flipping example, I told you we did a remodel of a condo. We deducted a bunch of stuff like hardwood floors, the laundry, the kitchen remodel. We deducted a bunch of stuff from what was our taxable gain. You can do that. Let me summarize again, because I think some people hear capital gains tax and think of some advanced financial instrument or formula, and it's definitely not that. Here's an example. A married couple, they've owned their home a long time. They bought it for $210,000 in 1987, lived in it as a primary residence, and recently sold it for $780,000. The difference is $570,000. That's your capital gain. As a married couple, the basic exemption for the primary residence covered $500,000 of the difference. So now only $70,000 is taxable gain. They paid the real estate commission, $39,000. They also claimed the $12,000 they spent to add a second bathroom. Oversimplification, okay? But in this equation, that leaves the taxable amount as $19,000. Out of the $570,000 you'd be paying taxes, only on the $19,000. Okay. I mean, if we're being honest, most of the market I work with, a lot of millennial home buyers and sellers, their primary residence, they are usually entirely exempt of paying taxes on their capital gains. That is far and away the most common situation here. So as a seller, again, if you've made it this far in the video, that should be good news. Investment properties are different. Even when you're diligent about those deductions, you end up owing, unless you employ a well-known strategy called the 1031 tax-deferred exchange. When you sell an investment property, a 1031 exchange will allow you to take those sale proceeds without paying taxes on them and put them into another property. You'll have limited time to do this, okay? This is not an infinite option for you. Investors actually use this little maneuver as a verb. You'll hear it as a verb. Let's 1031 out of this property into another building. If used correctly, there's no limit on how many times you can do a 1031, but to put it in simple terms, it allows you to cash out of an investment property and do a tax-free swap into another. This deserves a whole other video. I'm sure I'll go more in depth someday. Believe it or not, this is another one our president mentioned he had some plans for. Possibly he was even planning on doing away with it, doing away with the 1031 exchange in the lead up to the election anyway. I haven't heard anything else on it. And I mentioned my general skepticism of radical changes coming from DC, but absolutely worth monitoring if you are a real estate investor. Hopefully you've learned a little something about capital gains taxes. This is way more of a concern for investment properties. Landlords in Boston who own buildings which have highly appreciated during their ownership, it's a real thing. As fortunate as we look at their situation as being, they get smacked with capital gains taxes. But I think the main thing I wanted to show you here is it's actually a very simple concept and not some crazy, ridiculous calculation. As always, contact me with your real estate questions, Craig at powerrealtyboston.com, and follow us on Instagram at Power Realty Advisors. Thanks for watching.